You're sitting alone in your dark car. The glow of a trading app reflects off your face in red. That sure thing stock tip you bet half your savings on, it just filed for bankruptcy. It's a brutal realization, but it happens every day because of a psychological blind spot called overconfidence bias. Research shows that nearly 2/3 of everyday investors believe they have a high level of market knowledge. We convince ourselves that our personal research has uncovered something the rest of the world somehow missed. This chart shows the survival rate of professional active fund managers over a 15-year timeline. According to S&P data, roughly 90. If 9 out of 10 of them can't pick winning stocks over the long haul, the idea that an amateur trading on a smartphone can consistently beat the market is pure illusion. You are competing against an absolute machine. Professional trading floors execute millions of transactions in fractions of a second, fueled by real-time data feeds and armies of analysts. Internal biological wiring creates even steeper challenges. Behavioral finance research into loss aversion shows that humans experience the emotional impact of losing money twice as intensely as the satisfaction of a gain. This instinct forces us to hold on to declining investments far longer than rational logic dictates, simply to avoid admitting defeat. In a highly optimized system built on cold calculation, our emotional impulses actively sabotage our wealth. We become our own worst enemies. But even if you could completely suppress your emotions, the game is already rigged. Active managers are trapped by an unbreakable mathematical law. This diagram illustrates a concept formalized by Nobel laureate William Sharpe. The scale is perfectly balanced because collectively, active investors are the market. Therefore, before any costs are factored in, the total gross return of all active trades must exactly equal the average return of the market itself. But active investing requires vast resources. Managers charge high advisory fees, incur heavy transaction costs from rapid trading, and spend fortunes on proprietary research. All of these expenses act as friction, which must be dragged down from their final total. Because the gross return is identical to the market, but the operating costs are significantly higher, the average actively managed dollar must mathematically underperform the average passively managed dollar after fees. Sharpe's arithmetic makes the failure of active management a statistical necessity. For every manager who beats the index, another must underperform it, and both are weighed down by their own costs. You might look at a typical 1% annual management fee and think it sounds small, a tiny slice of the pie to pay for professional expertise. This line graph maps the trajectory of a 7% market return against a 6% net return over 30 years. Every dollar removed for fees is capital that is permanently barred from generating its own compounding growth. Over time, the investor loses the fee and the future returns that fee could have earned. This negative compounding effect snowballs over decades. By the time an investor reaches retirement, a simple 1% fee can consume up to 30% of the portfolio's total potential wealth. Investors are quietly bleeding out hundreds of thousands of dollars through this invisible friction, paying a premium to fight a war the math explicitly says they cannot win. If the statistics are this clear, the logical move is to abandon stock picking entirely and buy passive index funds. But that raises a massive question. What happens to the stock market if everyone actually stops trying to beat it? This flowchart illustrates an economic theory known as the Grossman-Stiglitz paradox. It argues that if a market were perfectly efficient, there would be no profit left in doing financial research. Without research, nobody would monitor corporate data or trade on news, causing stock prices to detach from reality and become highly inefficient. This is where active managers serve their true macroeconomic purpose. Blinded by hubris and motivated by the hunt for high fees, they deploy vast resources to uncover mispriced stocks. Their continuous trading is what actually establishes the fair value of companies, performing the exhausting labor of price discovery. The market operates as a self-correcting machine. It actually requires a large population of active investors, willing to pay high fees and suffer underperformance, to continuously set the accurate prices that passive investors benefit from. For the individual building their savings, the solution isn't to search for the few winning stocks hidden in the market. The solution is simply to buy the entire market itself, through a low-cost index tracker. You don't have to subsidize Wall Street's illusion of skill. By accepting the mathematical reality of passive investing, you keep your money compounding without the friction. Let someone else pay the heavy price required to keep the machine running.